Welcome back. On expiry day, when you're down close to around 85 points and have come off close to around 110 points off the high point of the day. We're just 20 minutes into the trading session, but it's not looking very, very good. The 17,450, that's the line in the sand that needs to hold out. As we saw yesterday, once we broke that 17,720 odd mark, we saw a quick 120 point downtick. So let's hope that at least at 17,450 odd mark can hold out for today's session. Well, let's get in our next corporate though. Metro, well, that's the one that we're focusing on. We have Nissan Joseph, the CEO of Metro Brands, who joins us on the show. Hi, Mr. Joseph. Good morning. Thanks so much for joining in. Well, when we last chatted, you were telling us about the kind of traction you're seeing in the 3,000 rupee per unit plus market. But first, I wanted to understand, how is the lower part of the of the market doing? What is your contribution coming in from sub 1,000 rupees? If you could tell us out there, and ask you this, because some of your peers, whether it's Bata, Relaxo, they have reported pain in that segment. Go ahead, sir.
Good morning, and thanks for having me. I don't think we're immune to what's going on below the 1,000 rupee segment. A lot of that is also because we've exited it driven by, a 700 basis point GST increase. So, right there, anything that was on the cusp of 1,000 rupees is now over 1,000 rupees. So having said that, some of it is self-inflicted. Some of it is an economic issue happening out there. There was also a lot of, pent-up buying the year before in all classes of trade. We just seem to have been able to sustain growth year on year in the over 3,000 category. And, I believe that when you look at travel across India, the value of travel is far exceeded that of pre-COVID, though the unit of travel hasn't. So people are choosing premium experiences and premium products in the way they live.
Mr. Joseph, just to get that number out, sub 1,000, how much does it account for in terms of your sales mix?
So for us, it was in the 13% range previously, and it's going to probably hover down a little bit from that. But again, like I said, some of it is self-inflicted because we exited the under 1,000 range because of the GST increase.
Okay, it has been actually a very strong move for you. In Q4, your revenue growth was around 24%. What do you think you can end the year with? And since you said that, travel is picking up and premiumization has also picked up quite a bit, what are the big trends you see in FY24, both in terms of growth as well as, triggers for your company?
I think the strategic initiatives that we put in place and the foundations for it continue to remain solid and have proven themselves over these last 4 quarters. And it continues to do well for us, and that is the process of premiumization of our products, our store expansion, steps that we're taking, our product differentiation and assortment. So we put a lot of strategic initiatives in place. And what we're seeing is the outcome of the results of all the things that we're doing. And we continue to believe that since we've based it on the unorganized sector moving to the organized sector, the footwear sector in general growing considerably, middle incomes rising and aspirations rising with that, tier 2 cities, tier 3 cities becoming more vibrant. All of those factors that we factored in to our strategic initiatives are playing out quite well for us.
Okay, I wanted to talk about one of those synergies, right? Cravatex, the company that owns the Fila brand, is what has become your subsidiary now from the 1st of December last year. Tell us a little bit about the synergies and the revenue scale that you foresee in the Fila brand, and what are we looking at in terms of profitability as well? Because in the last quarter, I think it's still an EBITDA loss that the company is sitting on.
Correct. So, we have a lot of experience bringing brands to India and making them successful, such as Crocs and FitFlop that are now in our portfolio as well. We see a lot of synergies between the Fila brand and what we do, not only what we do as Metro Mochi, but also what we do as private brands that we brought in and expanded in the country. Don't forget, at Metro Mochi, over 15% of our sales comes from athletic already. We are some of the largest accounts for some of the major athletic footwear retailers in India, footwear brands in India already today. So it's not like we are new to the athletic space. It was just a white space in our portfolio to not have a brand that we had the direct license to distribute and sell in India. The synergies also go beyond just our operational capabilities of running stores across all the states of India. It also extends to the fact that our multi-brand stores are great avenues to sell premium products like those of Fila.
So how big can it become then, Mr. Joseph? FY22 did around 150, 160 crores odd, and that's been the broad range. Where do you see this brand scaling to?
Yeah. So we have a lot of faith in where the brand can go. If you look at brands in India of the same ilk, they're north of 300 mono-branded stores. They're all doing quite a few hundreds of crores themselves in business. We believe that opportunity exists in India for any sports brand to capitalize on, provided you play your cards well and you do the right things. But the market size is huge and it's quite underpenetrated still. So it is not a matter of taking away market share from somebody else to have to grow. It is just a matter of playing your game and doing it right. We believe the opportunities for Fila are competitive to those of the other players in the industry that you see out there today.
Right, Mr. Joseph, Mr. Joseph, you said that in the past as well. You have big plans out there. I'm trying to get a number from you. Do you think from this 150 crores odd, it could scale, say, 300 crores in the next 5 years or so, or by 2025, do you have a target out there? Let's try to get a number out.
And I think we'll keep trying till we're ready to. What we're focused on right now is we're trying to make sure that we clean up the existing distribution and the existing inventory. That's number one. And then we're going to start putting our plans together for spring, summer of 2024 to launch the brand. I think we didn't get into this to just hold the business where it is. We think, a multiple of what it's doing today is a good aspiration to have and a good target to have for us.
We'll leave it there. Mr. Joseph, appreciate you joining in and good speaking with you as always. Good luck and thanks for that conversation as always. The market dipped to being down 90 points on the day and now it's come up a little bit. So a lot's happening even as we are kind of staying with some of the corporates here. We're down 60 points now, 17,497 or so. It gets us within 100 points of the budget day low. I mean, at the day's low today, we got to within 100 points of the day's low. So on the upside, after the 1st of February, when we had that big candle, and it was a huge one. On the upside, by the 16th of Feb, we had taken out the range on the upside, and now we're at the low point near the low of that day, the 1st of Feb day. And so it's been a pretty volatile last many weeks. Yeah.
The stock that's really getting hit now is Z. Yes. It's down 15%. And of course, we've been telling you that there's a big setback for the SL group, right? With the NCLT admitting IndusInd Bank's insolvency plea. So now there are a lot of lenders opposing the merger. So that is a big question mark. Will the merger go through in its entirety? Axis Finance, IDBI Bank, IndusInd have all opposed the merger. So look at that slide there. Huge.
From Abnish, the sense I got, and I think Nimesh also, maybe we'll revisit the topic, is that the amount in question is very small, right? And it's about 89 crores. They've already provided some 200 crores or so. This should be, and this goes to NCLAT now, the appellate tribunal. So we'll see how this proceeds from here. But I guess the worry is that the a deal with the merger with Sony kind of gets postponed, and that's why it's taking a bit of a knock. It's recovering already. It's down about 12.5, but that's a big slide in any case for a large name. Okay, let's move on. Last month, Happiest Minds announced the acquisition of Madurai-based IT services firm Sri Mukambika Info Solutions. The deal comprised upfront and deferred equity payments totaling 111 crore rupees. To discuss more details of this acquisition in terms of what things will look like, and of course, what's the business momentum like at this point in time, Mr. Venkatraman Narayanan, Managing Director and Chief Financial Officer at Happiest Minds, is now joining us. Thank you very much, Mr. Venkatraman. Appreciate you joining in. Prashant this side. First up, if you can tell us the rationale behind the acquisition, specifically with regards to the price paid. You're paying 111 odd crores for a company which has 9 crores in revenues. Let's start there, sir. Go on.
Okay. Good morning, Prashant. Just a small correction. The company closed at about $9.5 million. So compared to that, the payout of about 111 is about 1.35 to 1.4 times revenues. And it's a profitable enterprise. Has been around for 10 plus years, close to 14 years, if I'm right. And they focused on providing healthcare IT services to the healthcare industry. So they focus on a couple of very good accounts. And these have been accounts where we have tried to gain entry in the past. And we saw the kind of traction that those customers had with SMI. And that's how we got to know about this company rather. And since then, we've been tracking the performance of this company. And when the opportunity came to acquire them and make them part of the Happiest Mind story, that was what we did at the first go. It nicely fits into the acquisition strategy that we had laid out for ourselves. Maybe in terms of size, we would have liked to do a bigger one because the effort that goes into acquiring a $10 million or a $20 million company is relatively the same. So it's always ideal to do a acquisition which is larger than the $10 million size. But nevertheless, it gets us stronger into the healthcare vertical. It fits in very nicely into the product engineering business segment of ours, and they have shown good growth over the last couple of years, and we are evaluating the budgets and the plans for the next year, and we have seen that they are showing a similar kind of growth pattern for the next year. Profitable, good growth, and so fits in well.
Mr. Venkataraman, my apologies completely. $9 million, so you're paying less than 1 times sales, right?
No, $9 million would be about
you're paying
80 crores, 80.
Right.
111, right? 111.
Yeah.
So 1.3 times.
Yeah.
Okay.
So, in terms of margins, etc., where are things at for this company, and post integration, what will the combined entity look like? Yeah.
We don't see any margin dilution. They are also at the 25-26% kind of a number. During due diligence and during our discussions, that's what came out. And there are benefits of a merger with a larger company like ours. So integration benefits do happen, and we are likely to retain that kind of a margin outlook for that business.
The reason I guess we're asking you on overall margins as well is because now the supply side pressures seem to be easing. Attrition is down. Companies no longer need to hire at any cost. So this margin band, right, this 22 to 24% band that you had put out earlier, is there any scope to outperform?
We have been outperforming for 11 quarters. So I think... And the levers that we've had are foreign currency, the offshore, the huge offshore benefit that we are 95% of our people are based out of India. But as I've been mentioning in the past, many of these things could change and in line with some changes that happen in the economy, and which is why we are holding to 22 to 24, while continuing to make investments in technology, competence, and our overall approach to building capabilities in the domains that we have chosen to be in.
No, the reason I asked you is because as per the 9 months of this year, you're already at about 26.5%. So I guess you'll be beating that 22 to 24 band by the end of this year is what I was assuming. In the longer term, medium to longer term, what could the average be?
We have been holding on to this 22 to 24 in the medium to longer term kind of thing. For this year, yes, we had made a margin guidance of 25% plus in constant currency. As far as revenue goes, we'll meet and beat that. As far as margins are concerned, yes, we'll meet and we'll beat the guidance for the current year. The task in front of us is now to start looking at our plans for the next year and go on that basis.
All right. Hi, Mr. Venkataraman. You have cash in your books, I think, of around 700 crores, and you've taken an enabling resolution to raise some money via QIP as well. So my question to you is, will you all be going ahead with any kind of fundraise? Point number one. And point number two, you'll clearly have more appetite for M&A activity. Should we look to some more in the next 6-8 months or?
Yeah, we're consistently on the lookout for good companies to partner with and become part of the Happiest Minds family. So that's something that we continue to focus on. As far as cash on the books, you're right, we've got about 700 crores. We did take an enabling resolution, but the QIP market has been kind of, it's not been playing out in favor of the investee companies over the last few months, or let's say a couple of quarters, especially the IT industry with especially all the talk about the US recession and everything. Things have been kind of on a wait and watch mode, because QIP has certain pricing and pricing restrictions, and people have to go by that. But that said, right now we are in the process of discussion with our bankers and investors. In the right time, the board will take up an offer as and when it comes up. But in the meanwhile, we are going ahead with raising of debt because we are relatively debt-free right now. So we are raising debt and building that, I wouldn't say cash chest, but the resources that are required as we progressively look at companies to acquire.
Okay, just one question, because it's the hot topic of the moment. We saw Wipro reducing or slashing their employee pay for the freshers that they're hiring. I mean, are you looking to bring down employee costs as well, or is it just a one company phenomenon?
We have a current batch of 300 freshers or campus joinees who are undergoing training. So no changes there. We have made offer to about 400 and we are holding on to that. No changes there as well.
All right. Thanks very much. And apologies again for that, FOPper.
No, that's fine.
Thank you. Thank you very much.
That's fine.
For
Thank you very much.
graciously answering those questions. Thanks indeed. Well, the market, which is off the lows by quite a bit, we are at the high point of the day, actually, 20 points higher, and this is looking good. The low was 17,455. And from there, this is a V-shaped kind of a move up that we've seen from the lows of the day. So 17,570 is where we are at, so a big one. Let's look at if there is any such luck for Z Entertainment as well. Z is also picked up quite a bit from the lows of the day. We'll have that up for you. It was around 15. It's up about 7% from the lows. Nimesh is with us to run us through once again with what has happened and what he's picking up from conversations with analysts, etc. Nimesh, over to you.
Hi Prashant. So as expected, Z is opened lower after NCLT yesterday approved IndusInd Bank's insolvency plea against the company. Now, according to IBC, what this means is once the company is admitted to insolvency, moratorium kicks in, which means that barring any transfer of assets, this will clearly delay, according to most of the analysts, the merger process with Sony. Now, Punit Goenka, reacted last evening itself, and he said that is committed to the merger with Sony, and they will take all the required measures to achieve the quick and timely completion of the merger. Now, UBS has put out a note today morning. They have a buy rating on Z with a target price of 350, and they believe that the amount is not very large and it's very immaterial, which is only 83 crores, which is in contention with IndusInd Bank. But this will clearly delay the merger process, according to the UBS note as well. Now, according to UBS note, a company has a couple of options in front of them. One, to move to NCLAT against the NCLT order and get it quashed. So that could be the first option. Most likely, that's going to be the option that the company is likely to take as well, is what I understand from sources. And the second option is to pay this amount under dispute and go ahead with the merger process. So, this is a setback for Sony merger, so to speak. But a couple of things to track. One, the NCLAT process, if they get the order in their favor, so that's something to track. And if not, then whether they're willing to settle outside with IndusInd Bank. So these are the things to watch out for. But clearly, from today's point of view, the stock is down largely because there is an NCLT order agreeing to IndusInd Bank's plea of insolvency against Z Entertainment.
Okay, thanks a lot for that. So that's Z Entertainment, one of the most volatile and biggest movers in trade this morning. The other one we're looking at is GAIL. Sonal is here to tell us why she's watching that. Sonal.
Because there's a target price increase coming in from CLSA, they are quite bullish on the stock as well for a couple of reasons. Let me run you through them, because they are factoring in a 40% tariff hike. This is something that we have been highlighting as well. And for that reason, they have upgraded FY24, FY25 EPS by 14%. Now, recently, GAIL had put out a note. They proposed an integrated tariff for their pipelines, and this was across key gas transmission pipelines in its network. So they had asked for higher tariffs, citing some reasons as well. So if that is actually approved, it would imply a 70% hike from FY22 blended tariff levels. However, of course, there are some disagreements as well coming in from PNGRB. Even after accounting for that, CLSA thinks that tariff hike would be to the tune of 40 to 50% in the next financial year itself. They're expecting final announcement anytime by mid-March itself, because there is an open house on 6th of March. So after that, the final decision will come out. Additionally, share of utility part of the business in GAIL's EBITDA overall is increasing to 58%. Earlier, it would be the marketing segment, which has been very volatile and commoditized as well. In the cyclical commodity segment, in the part of the overall SOTP, it's just 19%. 80% is coming from GAIL's utility business. So that definitely means stable earnings, and that's why CLSA is bullish on GAIL.
All right, welcome back to Bazaar Morning Call. Well, for now, the market is really all over the place. It's recovered. It's made an attempt to recover. The Nifty is, just look at that. It's a complete U-turn that we've seen on the index and now approaching the 17,600 mark. Mitesh Thakkar is joining in. Mitesh, it's really a very volatile market as we speak. I mean, in less than an hour, it's sort of seen this big recovery and buy on dips. The mid-caps are also trending into the green almost. How are you approaching it? Is it a no-trade zone now? And what are the stocks to look at?
Oh, I think, as I said, the overall bias is on the downside, and I think, any pullback would be a chance to go short. So I think 17,650 is what I indicated in the morning. I think 17,650, 670 is the shorting zone for me, and a stop of 100 points from there can be taken. I think we will eventually not only test today's low, but a good chance that we'll break below that. So maintaining a negative bias, though, I think for the short term extremely, we have taken more profits on the short positions and trailed our stop losses, and even looked at some stocks where some kind of reversal is happening. So that kind of trade can be taken. In fact, I have identified the mid-cap IT space, LTI, Mindtree, and I think Tech Mahindra stocks like that are doing very well. So you can explore longs as well on the stock side. And on the index, my idea remains to short at higher levels. So currently, what I'm recommending is a buy on M&M Finance with a stop below 250. I think it's come down to very good support level. So buy with a stop at 250, look for targets of 265, 266 on the upside, and a sell on Ipca Labs, which continues to make fresh lows. That's a sell with a stop at 827 and a target of around 780 can be looked at.
Mitesh, we had the Metro Brands Management, and you just look at the chart for us, if you will. I mean, it's a very neat, clean kind of downward sloping trend line out on which, we kind of hit yesterday for the last 3 days, last 3-4 days, and today we have a bit of a down move. Can this extend?
Prashant, this is one stock, which has done very well. And if you were to look at the weekly charts, starting from 2nd of September, the stock has not broken 750, 740 zones on a weekly closing basis. While on the upside, I think 875, 900 remains a good area. So I think it's broadly, consolidating. Eventually, my sense is that it will break on the upside and the stock should make higher highs. But from a trading point of view, I think there is no immediate opportunity. But closer to the support area, I think anything close to 775, 760, I think excellent buying zones for the stock.
Okay. All right, Mitesh, thanks very much. Appreciate you joining in with that perspective and those trades. Commodities in focus. Manisha is here in the studios to tell us what she's tracking this morning. Manisha, good morning.
Can't keep away from the metal sector at all, because today it's all about that, whether it's about copper, aluminum, iron ore, or even steel prices. Everything seems to be really inching up. We are also facing lower production numbers as the international agencies are coming out with them, and that shows lower production for aluminum and copper and steel as well, and that has been supportive for prices. Take a look at the steel prices, and we haven't really seen a meaningful, profit-taking or correction come in for steel since the beginning of this year. We are now trading at a 7-month highs at Chinese yuan 4,250 per ton on the higher side of that. Actually, 4270 is the last that I saw the prices trading at. We have seen constant support come in for steel as China reopening post the lockdown. Almost all commodities, metals especially, have taken a lot of cue from that. And then markets also are looking at various stimulus measures that China has been putting out, record low interest rates in China, and the expectation that when you have an annual meeting happen in China in the month of March, there could be additional stimulus measures announced at that point in time as well. Inventories have continued to decline. This is the time when you start looking at restocking, because the second quarter of every year is when you see infrastructure and construction start with a very strong number. And at this point in time, we are looking at buying coming in from stockists as well as downstream companies also. The Chinese property sector has seen some steady moves after 16 months of decline, and that has been supportive for all of these construction metals. The strong US employment numbers and the CPI data that came in last evening also has been supportive, suggesting that it's not just Asia, but the US numbers also are improving, and that could be supportive for infrastructure. This is a report that World Steel Association put out, suggesting that the world January production for steel has been at 145.3 million tons, which on an year-on-year basis has seen a decline of more than 3%. So lower production, weak inventories, strong demand, all of that definitely has been supportive for the steel prices, which has seen a gain of 5% on a week-on-week and 2.5% on a month-on-month basis.
Okay, Manisha, thanks a lot for that. Let's slip into a quick break. On the other side, our special Indianomics segment, Lata will be in conversation with a whole host of guests to discuss the several trends that are indicating an improvement in India's